and welcome. We are so glad you could join us. For those of you who just came in, please keep yourself on mute during the webinar. If you have questions, please type them in the chat and Jon and Lisa will answer all your questions at the end. If you need to revisit any of the content today, there will be a replay available on our YouTube channel, Facebook page, and on our website. If you are watching this as a replay, we'll have contact information at the end if any of your questions were not answered today. So let's get started. Your financial security is our priority, and the relationship that you have with Mountain West IRA is incredibly important to us. This webinar is going to cover what we know right now about the budget reconciliation bill that's making its way through the Ways and Means Committee. There are provisions in this bill that are really quite concerning. A white paper on this 800+ page monster went on about all the wonderful things they were doing with $3 or $4 trillion allegedly to help you and me, the average taxpayer. It was sent out to media outlets and had some language that glossed over some facts that absolutely will affect everyone. If it passes with all the current language intact, these changes, if enacted into law, could have a direct negative impact on you. Jon and Lisa Galane, who are the principals at Mountain West IRA, have been looking into this proposed legislation, and they're here to answer questions that I'm sure many of you have. Jon, Lisa, thank you so much for coming on today to help shed some light on this monster of a bill. I'm going to go ahead and turn it over to you so that you can tell us what's going on. Thank you.
Without further ado, we're going to get started on this and get started on talking about this. Please ask questions, raise your hand or go into chat. Diana, I believe, is how you've got it. And we will answer all questions here. We'll stay on as long as we need to answer those questions. This legislation, and a little bit about how this came about, was there was a budget reconciliation bill. And in a budget reconciliation bill, the senators are capable of voting up or down how money is spent on a 50 vote plus one voting, instead of all bills that relating to non-budgetary items, which IRA is one of those, normally need to have 60+ people to approve of the bill. So what they did in this bill, this monster, as I understand the whole thing, somewhere around 2,200 pages. It's rather big, and it's combined. The House is attempting to combine this budget reconciliation bill with the infrastructure bill and vote on them together. So they're trying to do something that's mammoth and not been seen ever before in this way of doing it. Who knows if that's going to happen or if there's going to be separate votes on them. But the budget reconciliation in page 10 through 12 of the budget reconciliation bill falls provisions on IRAs, on Roth IRAs, SEP IRAs, traditional IRAs, HSAs, FSAs, and 401ks, which are called defined contribution plans. All of these plans have been targeted in this bill. And there were a couple of Democratic senators who felt that there were people making too much money off of their IRAs. And so they targeted these specific people. And I even think in our release to everyone, we talk about one of the people is Peter Thiel. And this man has made hundreds of millions, if not $1 billion in his Roth IRA with what he's done. So what they did was take this one person who they wanted to get to, and they wrote this broad law to prevent him to do anything he was doing. Well, it just so happens the same thing he's doing, small investors are doing. People with 100,000 or less also do the same thing. Most IRAs and self-directed IRAs have less than $100,000. and you've only got a very small handful. There's, and I will talk about this in a minute, but there is one section of this bill that talks about if you have over $10 million, you need to distribute over the next 2 years all money above the $10 million, or half of the money above the 10 million, all above 20 million. Pay all the taxes, pay all of the penalties if you're under 59 and a half, and any local or property or other taxes.
And if I may, I think it's important to clarify that that is aggregate. These thresholds include IRAs, Roth IRAs, 401ks, any sort of retirement plan that you have and are contributing to is affected, and that constitutes the threshold.
And unfortunately, this is really the only part of this section of the bill that's been picked up by anyone. So it makes it look like they're only going after people with $10 million or more aggregate between all plans. Unfortunately, they've put several other sections in here that eliminate the ability for any contributions to a Roth by anyone making over, I believe it's about 190,000. I don't know what the exact number is now. Diana can tell you the exact number. And they are also for taxpayers who make single over 400,000, married filing head of household 425,000, and married 450,000. So if your combined income total is 450,000 or more, there's also elimination of Roth and elimination of how you can put money in an IRA. This is the first time that income has been used to eliminate totally being able to put money into IRAs and limit 401ks, defined contribution plans. Also in defined contribution plans is for 403Bs. If you're a teacher, if you're a fire state employee, they have 403B is the same as a 401k. It's just a different letter of Treasury law.
Firemen, hospitals, teachers, those people contribute to a 403B, and they are also considered a defined contribution plan, so they're affected.
So basically all of middle class and upper middle class America is thrown in with these couple of people that these literally 1 or 2 senators and 1 or 2 congressmen wanted to take from. So without much, I'm not going to spend a lot of time on the 10 million and 20 million because there's only, by the way, 2,500 people in the US that have over $10 million in their IRAs and defined contribution plans. So you're talking about a massive change in law over 2,500 people. And whether it was done deliberately or accidentally, they've swept up all IRAs into this law. And I don't know which is which. I have my opinion on it, but I'll keep my opinions out of it. One way or the other, it happened. So the bill prohibits any IRA. When I say IRA, I'm talking all inclusive IRAs and defined contribution plans. I'm just going to use the term IRA so I'm not repeating myself. From holding any security if the security issuer requires the IRA owner to have a certain minimum level of assets, income, or if to completed minimum level of education or obtaining a special license or credential. For example, and this is a lot of our clients are accredited investors. So if you had to sign an accredited investor form to have units or shares inside of an investment, you are then one of these people that will be forced, not at any income level, but just because you signed a document that said you're an accredited investor, you will be forced to distribute your IRA assets over 2 years and pay all taxes, pay any penalties if you're under 59 and a half. And if you can't liquidate, which many of these investments are non-liquidatory funds. In other words, there's a period of time you have to hold these 5 years, 10 years, whatever it is. You still have to pay all those taxes within 2 years. And this will cause bankruptcies to skyrocket because some people aren't going to have, if they've done well in their IRA, they're not going to have that tax money available to be able to pay those taxes. This is one of the most devastating parts of this plan, because it's not only accredited investors or any kind of multi-unit LLC or private company stock or anything where you had to have some kind of assets in it. It hits all of those. And it also puts, if you have a single member LLC, if you have real estate in a single member LLC, it also puts those LLCs at risk, because the language is vague enough that it could sweep up the single member LLCs. And in this bill, Congress gives the IRS the right to make up rules as they go. This is also a first. This has never been done before. So the IRS gets to, if they decide that something shouldn't be in an IRA, they get to change the rules after Congress votes based on their belief on whether it should be in an IRA or not.
So this has always been managed, and the oversight has always come from Congress on retirement plans. This will be the first time that this sort of power, so to speak, and oversight has been given to the IRS.
Literally, Congress is giving up their power and their responsibility to the IRS to make rules once this vote happens, if it gets voted in. And while I'm talking about it, because I will forget about it later, this Congress is also in the same bill giving the IRS $73 billion to be able to find and do something about anybody who they feel is abusing not just their IRAs, but any tax abuses. And here's the horrific part of this is these new laws, the GAO put pen to paper and they said this set of laws will raise $1.2 billion. So a vote on something that will raise $1.2 billion, Congress is then turning around and giving $73 billion to the IRS to find that $1.2 billion. It makes absolutely no sense what they're trying to do. And it makes no common sense why they want to do this with IRAs. There are several things that they've never done before. One is, anytime there's ever been a change in tax law concerning retirement savings or tax deferred savings like life insurance policy, the Congress has always grandfathered in the prior rules, even if they change them going forward. So everybody who already has it doesn't get affected. That's not in this bill. There is no grandfathering. So anybody who has these investments is not safe from having them removed from the IRAs and paying taxes and penalty. That has never been done in the history of the United States. It also expands the statute of limitation for non-compliance. It used to be on prohibited transaction or non-compliance in an IRA. It used to be 3 years for the IRS to find it and say something to the taxpayer. Now, mind you that every business, every corporation, every business, everyone in America, the IRS can only go back 3 years to find those transactions and start the process of audit. In this bill, it allows the IRS to go back 6 years on IRAs, which everybody is asking, if you can only go back 3 years on all corporations, why would you allow 6 years on IRAs? These are not major corporations, these are individuals. So it doubles the time that the IRS can come after people. Let's see. Self-dealing. Under current law, prohibited transaction rules, the IRA cannot invest their IRA assets in a corporation, partnership, trust, or state, which they own 51% or greater interest. In this bill, they are taking that from 50% ownership down to 10%. So if you're in a private corporation or a trust or something where you've got IRA assets in there and you own between 11% and 50%, you will have to distribute down, and we don't know if this is down to 10% or if they're going to say distribute all, but it looks like it adjusts the threshold down to 10% on all non-tradable investments. So it looks like the IRS will demand distribution with all taxes and penalties on that, on anything over 10%. The bill also prevents people from investing in an entity where the IRA owner is an officer, which means that this is the problematic thing for single member LLCs, because you're an officer in your own corporation. And we've had some people that have made comments to us, well, why don't you give us advice how to get around that? Well, first of all, we don't give advice, but that beside the point is nobody has figured out where the loophole is. Believe me, there are attorneys trying to figure it out, and there has been nothing found that protects any of these assets. This bill literally puts a spear through the heart of any kind of non-marketable unit or stock or LLC investment, anything that isn't a marketable security, which is, and I'm going to give you my opinion here. It's my opinion that the regime in Washington, the new who's in control, they don't want anybody to invest in anything that they don't have total control of. They have total control of banks, and they have total control of the stock market through the SEC and NASD. None of that has been touched in this bill. So anybody who invests through the stock market, the only rule that applies to them is if you have over $10 million or $20 million. And it reeks of discrimination against small investors and non-security investors.
Interestingly enough, what has been left out of this bill is defined
benefit
plans.
Yeah, it's very, and if you got our letter, there's a paragraph in there that which says, never in the history of this country have individuals been limited to making contributions to IRA or defined benefit plans. That let me correct that. That's defined contributions. Interestingly enough, all defined benefits plans have been left out of this bill. Why is that important? Congress, the Senate, the President, and major corporations all have defined benefit plans. Individuals don't have defined benefit plans. So literally, this is a bill to protect the wealthy and elite and take money from either those they don't like that made too much money in their accounts or the small investor. And again, I say we don't know if it was deliberate or accidental, but it will have severe ramifications. Now, big question, because I know a lot of you are real estate investors, where the real estate is sitting in your IRA. This is not discussed in the bill. However, the IRS has never liked real estate in IRAs because they can't get a marketable value on it from a market ticker like you can from the stock market. So even though it doesn't show up in the bill, the fact that the IRS can make rules may put some of that at risk. We just don't know. We don't know what's going to happen. But attorneys and people that are lobbyists in the industry have known that for a long time, the IRS has a disdain for real estate and IRAs. So I'm not trying to scare anybody. I'm just trying to say that this bill gives the IRS too much leeway over our lives. And that's problematic. I will say, let me wait till the end on that. Right now, we estimate that this bill has 70% chance of becoming law. And there's been discussion over the last week that the amount, the $3.5 trillion may come down. Maybe they'll negotiate and they'll end up being 1 or 1.1 trillion. The problem is nobody's negotiating the IRS section out. They may reduce the amount of debt they put the country into, but this section on IRAs and defined contributions is not does not look like it's going to be removed, and that is problematic. I will say that there is reporting that Kristen Sinema, Senator from Arizona, and Joe Manchin from West Virginia had a meeting with Joe Biden recently that went very badly, because Joe Biden wants this bill and has already told Congress and Senate he will sign it as soon as it hits his desk. The Vice President, Kamala Harris, has already said she will vote for it on a 50-50 tie. So there is a lot of powerlessness in this bill, but there is a lot of power with Kristen Sinema and Joe Manchin. They literally can put the complete brakes on this thing. I understand they're very dissatisfied with the meeting they had with Biden. And we also understand that, and actually I have heard this from Joe Manchin's mouth, is he doesn't want this bill touched until 2022. By the way, all the sections of this bill become law as long as it's signed before December 31st. It becomes law December 31st, and everything takes effect January 2nd, 2022. Manchin doesn't want this bill touched. He has refused to vote for it, that he will only vote for the infrastructure bill separately. So literally those two Democratic senators hold all of the power on this, and they hold all the capability of keeping this thing off the books. Yeah, go ahead.
Nope, that's it. So anyway, that's the bill in a nutshell. We just did have a request. There's a portion to go over the portion of the bill dealing with Roth IRA conversions. So regardless of your income at this point in time, currently, you can make a non-deductible, if necessary, contribution to a traditional IRA and convert it to a Roth and pay taxes on that conversion. This bill will remove that capability. It's commonly called the backdoor Roth conversion, and it's been used for 10 years.
And just to give you a little more background on that, back in 2010, Congress agreed to allow people to move money from traditional IRAs to Roth IRAs to have tax-free savings because of the benefits to them. So in 2010, they passed a law that said no matter what your income is, any income level, even if you make too much to put money into a Roth, back then I think it was about $140,000 as a married couple. If you made too much money, you could take funds, put them into a traditional IRA, and instead of writing them off, move them in the same year to a Roth and just pay taxes on the money with your regular income taxes. And then going forward, that would be tax-free. That all goes away. All backdoor conversions, all ability to put any money in a Roth, all goes. Literally what happens is the Roth IRA goes away. Even if they keep the name of it, for all intents and purposes, the number of people that will be able to and will want to be in Roth is severely reduced. So, and the Roth IRA originally came about in 1996. There was a senator named Roth that brought that up, and they wanted a way to give people the right to have tax-free earnings, to not write it off, but be able to earn tax-free so that they could substantially increase their retirement savings and not have to depend on the government. We're in a whole different world now with a whole different situation. There are also people, there's a question that was asked. Hi, Byron. There was a question that was asked about precious metals. Nothing in precious metals and currencies is addressed in the bill. Currencies have a value, and it can be pegged to something else. So we don't believe that currencies are going to be effective. You have the same situation. You've got a market for gold and silver and other precious metals. We don't believe that's going to be affected either. So our best estimate on that from reading through this is precious metals and currencies will not be a problem. And we don't believe that real property will be a problem either until the IRS gets a hold of this thing and we see what the rules are.
John, I have a couple other questions that have come in for you.
Yes.
One is from Harv. He says, can you roll affected IRA into another traditional IRA?
No, they are combining all IRAs and deferred defined contribution plans all together into one. So they're looking at them as one entity. An aggregate amount. So you could open 10 IRAs and put different things in those 10 IRAs. They are now all aggregated. That also was not the case prior to this law, if this law goes through. So now everything will be aggregated and considered to be one.
Thank you. I have another question for you from Bev. Does this affect retired people too? Will we be grandfathered in?
No, there's no grandfathering. You will be affected just like everybody else. You won't have the early withdrawal penalties, but you will have all the taxes and you will have to distribute if you meet one of the criteria that they're voting on. So retired people are not exempt. There is no grandfathering anywhere in this bill for anyone. Never before have we seen anything like it. I don't know. I'll try my hardest to keep my opinion out of this, but you know.
John, we have another question. What about precious metals accounts that are held in an LLC?
That's a problem. That goes under the LLC rulings, goes under the 50 down to 10, or it goes under the
being the member,
being a director, or holding a position. That's a problem. Anything where there's an entity involved becomes a problem. See, here's a question on and ask for clarification. We hold one piece of property in an LLC and are sole members. Wife and I are managers of the LLC. This bill may affect your ability, and I believe it will. Because of the lack of clarification they're giving the IRS the responsibility on, but because you're officers, because you're managers in the LLC, yes, I believe it will affect that. Now, it's been suggested that you might be able to distribute the real estate in an LLC out of the LLC prior to the bill taking effect, and then just distribute the empty LLC and keep the real estate in.
You would essentially, and I don't want to get ahead of us or give advice, but based on the language as it is written now, this is affecting private placement investments, which an LLC falls under. So if the LLC were to be removed, and by that it would be liquidated, so the LLC would be sold and the property would then be held as real property vested in the name of the IRA without the LLC, that appears, as the language is written now, that would be acceptable.
But
holding the real property is acceptable.
Let me just say this. If you're going to think about doing this, if this bill were to become law and you thought about doing that, please consult an attorney.
Absolutely.
Because we don't want to tell you something. We don't know what the rules are that the IRS is going to write. All of a sudden they could pass this bill and the IRS writes a rule that any distribution of an LLC directly into an IRA will be considered the same, and that eliminates that. So please consult an attorney if this bill gets signed. I'm making sure that you're not setting yourself up for a prohibited transaction that could have other ramifications.
And a good attorney or a CPA would be necessary. We just don't know enough about what will actually be in this law when it's passed, and so it's really a guess at this point.
I have another question that came in. I'm 70 years old, had a Roth for over 5 years, so that means it's qualified. If 2-year distributions are forced on a Roth, will they impose taxes and or penalties?
We don't believe so. We believe that the Roth will still have its tax-free status. Penalties, yes, if you're under 59 and a half.
She's 70.
Right, she's 70, but I'm just saying in general, if you're under 59, but no, at 70, no penalties or taxes, as it looks like it's written now.
And if you don't have an affected asset in the Roth, it doesn't appear that there's going to be impact whatsoever as it is written now.
As long as it's not over a $10 million account.
As long as it's under 10 million.
The aggregate.
Aggregate between all IRAs and defined contribution plans.
And I just had another question. Does the aggregate include all accounts, even traditional and Roth?
Yes.
Traditional IRA, Roth IRA, HSA, FSA, 403B, 401k,
Simple, SEP.
simple, SEP, KEO. For those that have the old KEOs, that falls under defined contribution. So same thing. So, and nobody's had a KEO now for probably 15, 20 years, but there's old KEOs that are still in effect and people are using. So all of those fall under one mass heading and are all combined for one account to get to the 10 million. So.
And I do have another question from Cliff. Does this include 457s?
Yes, defined 457s are a defined contribution plan. That's state, federal. Those are all defined contribution plans, and yes, they are affected. Yeah, deferred compensation plans, which is what a 457 is defined contribution. So yes, they are also considered in the aggregate. The only thing left out of the aggregate is defined benefit plans, period. If it's not a defined benefit plan with full actuary tables, then it's affected.
I have another question from Harv. If you have other IRAs with outfits like Schwab or Fidelity, are those affected?
No, those are marketable securities. The only effect on those would be if your income is over the 400 or 450 threshold, and obviously the Roth portion affected, and the 10 million. So the only parts of this law that affect distributions from marketable securities are the 10 million, the 20 million, the 400, and the 450. The rest doesn't matter, as long as if it's controlled by the SEC, which is a government entity, they're fine with that.
I have another question from Floyd. Sounds like owning real estate in an LLC would be a problem, but if the ownership is by MWIRA, FBO, will that be better?
As we understand it now, before the IRS gets a hold of this thing, that looks like the way to go. Until the law, well, I hate to even say it because it's a negative thing, but if the law were to be passed and it goes to a rules committee at the IRS, we're not going to find out all the ramifications to this until the IRS gets their grubby little paws
But
on it.
as it is written now, Floyd, real property is not addressed. It's not addressed in this language. And
Yeah, there's no
whatsoever.
language on real property.
So as of now, real property is allowed as it has been.
If anyone has any additional questions, please go ahead and put those in the chat.
I know that you've probably heard this from us before. You've probably seen the writing on it, but please contact congressmen, contact senators. If you know people in the media, contact the media. We've been trying to get people in the media to talk about this. It's being left out. They're talking about the higher taxes, the higher capital gains at 39%. They're talking about the tax rate increase on people over 400,000, 450, but everybody is missing this, and it's very frustrating. We're trying to get the word out.
And there are people in our industry that are blogging, and I mean it's getting out there, but I think we just need it to be spoken about in mainstream media would be very helpful. So that's what we're working on.
And all of us are working together, by the way. Every company out there, we're having conferences on it, and we're working together on it to get the word out. From the very biggest to the very smallest, we're all on the same page. We've got a lobbyist in Washington working on it. There's attorneys in Washington working on it. So we're doing everything we can. We're just asking people to grassroots, get out there and also contact. If you know a Democratic senator or congressman, I have heard rumors recently in the last couple of days that there are 4 or 5 congressmen that all of a sudden are starting to get cold feet on this thing. And we need 5 Democratic congressmen to get super cold feet and refuse to vote for it, and it stops it in the House. That's all it takes. That's how close it is. So, and then you don't have to worry about a 50-50 vote in Senate. You don't have to worry about the leader of the Senate, who's the vice president. So we're making inroads. It's just time and energy and getting them to understand how horrible this could be for people.
And we will have contact information so that you can contact your senators, your congressmen, so that you can let them know that this really does affect you and you're not happy with it. We do have a few more questions, Jon and Lisa.
Okay.
From David, we purchased an investment rental property with our MW IRA, used 33% IRA and paid cash for the remainder of the 67. Will we have to sell the house or take penalties on the 33%?
As it's written right now,
No.
it's not addressed at all. So it doesn't, something like that shouldn't be affected.
As it's written
As
now,
it's written
it
now.
would not be affected.
Yeah.
Real property is not being affected by this bill.
Yeah, even if it's owned inside and outside, real property is not in this bill at all.
And David says, thank you. Question from Blake. The transfer of ownership goes to MW IRA. Would that need to happen before the signage of the bill?
This is only personal opinion. My personal opinion is yes. If it looked like the bill were going to be, actually, it doesn't matter when the bill is signed. The bill becomes law when it's signed, but the start date of the law is what's important. And the start date would be December 31st. So if this bill were to go into effect, anything that you wanted to have happen, you would want to have happen before December 31st.
And the Senate this most likely is it's in the House now. I don't know when the vote's going to be, in the next 3 or 4 weeks, potentially. And then it goes to the Senate.
The House wants to vote on this before the end of September, but I'm hearing rumblings that all of a sudden, we're not the only ones. There's other things in there where people are starting to have difficulties with it, a lot of difficulties, and are starting to fight back against that small group of progressives that are trying to get this through. So, we can only hope.
And one more question. Just want to clarify what was said. Real property is not included, but LLC ownership is included. So doesn't that mean that real property is included?
No. If the real property is in the LLC, the IRA doesn't hold the real property. The IRA holds the LLC. If the IRA holds real property, in other words, the deed to the property is deeded in the name of Mountain West IRA for the benefit of David, that's real property. If the IRA holds
Units in an LLC.
Units in an LLC, 100% of an LLC, if the LLC unit is what is held at Mountain West IRA or any self-directed administrator, that's the problem. Because the real estate is not being held by us, only the LLC is.
The underlying business of the LLC
Is real
would
estate.
be the real estate.
But that's the LLC's business. That's not in the IRA.
Correct.
I hope that clarifies a little bit, or if it doesn't, let us know and we'll try to clarify it more. Yes, Beth, I'm going to agree with you.
Beth says until the IRS gets a hold of it. That's right. That's why we don't want them to have that power.
That's right.
So thank you all for attending today, and great questions. We just wanted to have a Q&A session and do what we could to clarify any issues that anybody may have, and just kind of go over the highlights, or I should say the lowlights of this bill.
We will have a replay of this available again. And in that replay, we will also include information on how you can contact your representatives to let them know that you are incredibly unsatisfied with these sections of the bills. And if you have any questions, please feel free to call us anytime. As we find out more information, we will absolutely share it with you.
If we have good news, we will share it just as fast as we shared the bad news.
Yes, absolutely.
Absolutely. Thank you very much. And thank you all so much for joining us. And Jon and Lisa, thank you for looking into it and keeping an eye on this bill for us.
Thank you. Thanks,
You are
Harv.
most welcome, everyone, and we will keep you all informed as soon as we know anything.
Thanks, Beth.
Thank you, everyone.
Oh, wait a minute. We have one more question.
Post all Democratic congressman contacts so that we can do all of them. Yep, we'll all work on that.
Wait a minute. There's one more
From
from
Gina.
Gina. So since I have a check writing capability, my LLC is the owner of the Roth. Well, the LLC is not the owner of the Roth. The Roth is the owner of the LLC. So, and yes, with the Roth being the owner of the LLC, there's a risk that that LLC could be forced to be distributed. And then the next part of that question is, should you change it? You should consult an attorney to make sure you can change it and make sure that there won't be ramifications from that. That's legal advice that we can't give. So Gina, contact an attorney, a real estate attorney or a business attorney. Either one can help with that. And they can tell you if there's a possibility of getting that out of the LLC.
And we do have attorney contacts available on our website under resources. And Gina, I will talk to you tomorrow at the real estate investor meeting.
Awesome. Thank you, Diana.
Thank you, everyone.
Thank you so much.
Thank you, everyone. Have a fantastic day.
You too.
Bye.